As you approach retirement, should you be putting additional savings dollars into your RRSP or into your tax-free savings account? This is a common question that people come to me with as they approach retirement. So the answer is it depends. And in this video, I'm going to walk through the differences between RRSPs and tax-free savings accounts. I'm going to walk through a couple of different scenarios to illustrate how using one account may make more sense than using the other account, depending on your situation. And then I'm going to close the video with some key takeaways that you can use as you prepare for your own retirement, as you think about this question for your retirement savings. And if we haven't met yet, my name is Mark Walhout. I run an investment advisory and financial planning business called Walhout Financial. And I put together this channel to share ideas and concepts that I'm using to help people with their retirements every single day. If you want to get more videos like these, consider subscribing to the channel. If you have any questions or comments, please drop them below. And now let's get into the video. So now I'm going to walk through some of the properties and features of the RRSP account and tax-free savings account. This is not going to be an exhaustive deep dive into each of the account types and all of the different rules around them, but really it's just a refresher to position sort of the next phase of the video where I walk through some scenarios. So I'm going to go ahead and share my screen with you. And I put together this really simple visual that's going to look at the differences between RRSPs and tax-free savings accounts. So at a high level, RRSP contributions are made with pre-tax dollars. What that means is you make a contribution to your RRSP, you get a tax slip that allows you to deduct the amount of that contribution from your income taxes in the year that you make the contribution. You also have the option to defer taking that deduction in the year that you made the contribution. You can defer it forward. But a lot of people, when they're in a high income situation today, they make that RRSP contribution and they deduct it from their income in that year. The money that is in the account, once it's in the account, it grows tax sheltered. And what that means is if the account accumulates dividends or interest or there are capital gains that are realized inside of the account, there's no tax bill to pay at that time. The tax bill does come eventually though. It is when you eventually take money out of the account. And so the reason why I put in this line here that says high in, low out, that's really the ideal situation for using an RRSP. It's when your income level is higher, or your income tax level is higher, your marginal tax rate is higher at the time you make the contribution, then eventually when you plan to take the money out of the account. And this is a very common scenario for most people who are approaching retirement. They're currently earning higher income today than they expect that they will be realizing eventually in retirement. This is a very common scenario, which is why RRSPs generally make a lot of sense for people who are accumulating for retirement. More recently, starting in 2009, we had a new account that was introduced, and it's the tax-free savings account. So in many ways, I describe the tax-free savings account almost as the mirror image of the RRSP. And what that means is money that goes into the tax-free savings account is after-tax dollars instead of pre-tax dollars. So you don't get a deduction at the time you make a contribution to your tax-free savings account. Similar to RRSPs, money in the TFSA grows tax sheltered. So interest, dividends, capital gains that are realized in the TFSA, there's no tax bill to pay while it's accumulating in the account. And the greatest feature of tax-free savings accounts, again, going back to my earlier statement, it's the mirror image of the RRSP. Remember that withdrawals from the RRSP are taxed as income. Withdrawals from your tax-free savings account are not taxed. They're tax-free growth after the money's in the account, and the withdrawals are tax-free. And so the reason I put this line in at the bottom, equal to or lower in and high out, what that means is that tax-free savings accounts generally make the most sense when your income level, your marginal tax rate, your average tax rate are equal to or lower than your expected income tax rates, average tax rate, marginal tax rate, eventually when you make the withdrawal from the account down the road. And so this is sort of positioning. I wanted to just kind of give you an idea of how these accounts work as we now move into a couple scenarios where we look at somebody who's getting ready to retire and consider for them whether using the RRSP makes more sense or the tax-free savings account makes more sense. So now we're going to walk through a couple scenarios. We have two individuals who are planning to retire. They're not related. They're two single individuals, and they have some money set aside that they're thinking about putting towards their retirement savings, and they're wondering whether they should put that money into their RRSP accounts or into their tax-free savings accounts. So I'm going to go ahead and share my screen with you, and we're going to walk through this scenario. So we're going to start with Janie. Janie earns $200,000 per year. She plans to retire at the end of this year. We expect that her income taxes this year are going to be around $70,000, and that puts her average tax rate at around 35%. We expect that her income in her first year of retirement is going to be around $70,000. Her income taxes at that level of income should be around $13,376. That puts her average tax rate at 19.11% in her first year of retirement. She has $30,000 that she wants to put towards her retirement savings, and we decide that we want to put that money into her RSPs. Immediately, that will result in a tax savings for her this year of $14,505. Now, let's imagine that she turns around and next year, while she's in the first year of retirement, she turns around and wants to take that same $30,000 out of her RSPs. Recall that she's in a lower tax situation now that she's retired. She's earning $70,000. And so let's just assume that we're going to add that $30,000 withdrawal to her income in that first year of retirement. That's going to result in an additional $9,897 of taxes next year while she's retired. And so simply if we take the difference between the income tax savings by making her RSP contribution of $14,505 and then subtract from that the amount of taxes that she's going to pay if she makes that withdrawal next year, she realizes a tax savings of $4,608 just by using the RSP. That's ignoring any investment growth, by deducting that contribution this year in her final year of employment and then simply taking it out next year while she's in a lower tax situation. There's a huge amount of tax savings by making that decision. Now let's go over and look at our other retiree. His name's Johnny. He and Janie are actually colleagues, but he's deciding to retire earlier this year. He's going to retire in April. And so he's only going to have $50,000 of income this year. So if all he has this year is $50,000 of income, that's going to result in $7,458 of income tax this year, and it's going to put him at around 15% average tax rate. Similar to Janie, he expects that his income next year, his first full year in retirement, is going to be $70,000. His taxes are going to be the same as Janie's, $13,376. His average tax rate is going to be around 19.11%. He has the same $30,000 that he wants to set aside and put towards his retirement savings. He doesn't speak to his advisor. He simply just puts that money into his RRSP account, and he deducts that contribution from his income this year. So making that contribution will result in tax savings this year of $6,171. Now let's assume that, similar to Janie, he wants to turn around next year and take that $30,000 out of his RSP, adding to his $70,000 of planned income next year. That's going to result in additional taxes of $9,897, just like Janie. And what you see here is actually a tax loss. What that means is that the value of his deduction, $6,171 this year when he made the RSP contribution, the amount of tax that he saved is less than the amount of tax that he's going to pay next year when he's in retirement because he has higher income next year. So he actually realized a tax loss by making the decision to make an RSP contribution this year versus what he probably should have done, assuming that he had room, which is take that $30,000 and put it into a tax-free savings account. So what this summary is meant to illustrate is that point that the tax situation that you're in at the time you're making the contribution makes a big difference, and also the amount or the tax situation that you expect to be in when you make the withdrawal makes a big difference in deciding whether you're going to contribute to an RSP account or a tax-free savings account. Again, going back to our earlier diagram, when your income is higher today than you expect it to be while you're going to take the withdrawal later on, generally the RSP makes more sense. If your income tax situation today is similar to or equal to or lower than your income tax situation when you expect to eventually make the withdrawal from your tax-free savings account, the tax-free savings account tends to make more sense. The scenario that I just described is a fairly simple scenario, and it's meant to illustrate the importance of knowing our current tax situation compared to our expected future tax situation when deciding between using tax-free savings accounts or RRSPs. But there are other things other than tax rates that we want to think about as we're making the decision between these two account types as we approach retirement. And recall that RRSP withdrawals are taxed as income when we make those withdrawals in retirement. Tax-free savings accounts, on the other hand, those withdrawals are not counted as income. And there are certain income-tested benefits in retirement that might be clawed back if your retirement income rises above certain thresholds. And so in this next segment of the video, I'm going to introduce what a couple of those benefits are, those programs are. And if you have more questions about these programs, leave me a comment or a question below, and I could maybe do a deeper dive on these programs. There's enough detail here that they probably deserve their own separate videos. But I just want to introduce some of the other things you want to consider as we're trying to figure out this retirement puzzle when deciding what account types to use. So the first benefit that might be impacted by higher income in retirement is your old age security benefit. So if you're a resident of Canada, you lived in Canada for the decades leading up to retirement, you're going to be entitled to at least some measure of old age security. You can begin collecting those benefits as early as your age 65 year. And the benefit that you can earn from old age security, the highest benefit this year, if you started this year, is around $8,300 or $8,292 to be exact. And that benefit can be impacted if your income in retirement is too high. So if your income in 2023 is higher than $86,912, your old age security benefits begin to be clawed back at that point. So for every dollar of income that you earn over that $86,912 threshold is clawed back by 15 cents on every dollar for every additional dollar of income that you earn. And I'm going to illustrate with a really quick example. So let's assume that Janie, our retiree, she's earning $100,000 this year, and let's assume that she's 65 and she's collecting old age security. She's over that $86,912 threshold by about $13,000. So we multiply that, to be exact, $13,088 by 15 cents or 15%. And that results in a clawback for Janie of $1,963.20 of her old age security benefit. So the amount of income that she's generating now in retirement, at least in that first year, did result in an additional tax, in a way, a clawback of her old age security. So she's going to want to be mindful of that as she considers how she constructs her retirement income and what account types to be drawing from. The second big one is the age amount tax credit. So Canadians who are over the age of 65 are entitled to an age credit. The credit in 2023 is $8,396. And to figure out what that means in terms of tax savings, you simply take the credit and you multiply it by 15%. So it has a value to a full recipient of the age amount tax credit of $1,259.40. Once a retiree's income goes above $39,826, that credit begins to be clawed back, and it's fully clawed back once income exceeds $92,479. Those are just a couple of examples of income-tested benefits that many retirees need to be mindful of as they're constructing their retirement plan. But these also do weigh in on the decision of what account types to be using as we're approaching retirement and which account types to draw from as we work through retirement. So in closing, the question of which account to use for retirement savings as we approach retirement is a very common question. I hope that this video has provided you with some context to help you with this decision. The key takeaways for you if you're watching this video and you're approaching retirement. Number one, generally speaking, if you are in a higher income tax situation today than you expect that you're going to be in when you eventually make the withdrawal from your retirement accounts, in most cases, RRSPs tend to make the most sense. There are other forces that are going to weigh in on this decision, including your tax credit situation and potentially old age security clawbacks. So these are just things you're going to want to think about. But by and large, if you're in a higher tax situation today than you expect to be when you make withdrawals in retirement, by and large, using the RRSP makes more sense. Ideally, you're maximizing both programs. And this is implied in the question of which account type should I use. It's kind of like a decision between should I use this one or that one. Ideally, if you're approaching retirement, you're maximizing or leveraging both of these programs to provide you with tax deductions while you're making contributions to RRSPs, tax sheltered growth, and in the case of using a TFSA next to an RRSP, tax sheltered growth, and eventually tax-free withdrawals when you make the withdrawals from the account. So hopefully you're using both accounts. It's not just an either or scenario. There's power in using both of these vehicles. And then the final takeaway is that these decisions shouldn't be made in abstract. This video is really meant to help you think through some of the ways that a decision here might impact your retirement plan. But the decision to use one account type over the other should always be made in the context of a financial plan. Ideally, you're working with a financial advisor who's kind of helping you through these decisions in a scenario that's specific to you and your financial plan. So if you have questions about this, again, feel free to drop me a question or a comment below. If you want to get started on looking at a retirement plan that's specific to your situation, I've dropped some resources in the comment section that hopefully, or in the section below, that can help you get started. But I hope that you've enjoyed this video. If you liked it, give it a thumbs up. Consider subscribing to the channel to get more videos, and I'll speak with you soon. Take care.